Maybe you've owned stock and now you're thinking about a way to grow a small account faster than your 401k or retirement account, maybe even as a side business. If you're new or learning option trading, there's a simple strategy that should be one of the first ones that you start off the bat with. In this video, we are going to cover what is a short put credit spread option strategy. What are the advantages of selling short credit spreads? Is selling put credit spreads risky? How do you sell a short put credit spread? And we'll show a real example on the option trading platform. Hey guys, Darren here. We've got a tremendous video for you here today. All I ask before we start is if you please hit that like or subscribe button. I'd really appreciate it. It helps out the channel, so thank you very much. Today we're covering the short put credit spread. I think it's important that we understand all the different strategies and the ways that the rich are getting richer so that we can do the same and use the same tools to profit in any market. I promise we're going to dig into many detailed option trading tips and tricks in this video and future videos going forward. Be sure to download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. What is a short put credit spread option strategy? The short put strategy employs two put options to form a range consisting of a high strike price and a lower strike price. The trader receives a net credit from the difference between the premiums of the two options. Okay guys, when we say short, we are just saying that we are selling the put credit spread as opposed to buying it. In other words, we receive a net credit when we place the trade. If we were to buy the credit spread, then we would pay a debit when we place the trade. So it would be what is called a long credit spread. However, if you follow this channel, then you know that it's much higher probability to sell options as opposed to buying them. So we are going to focus on selling the put credit spread. What are the advantages of selling put credit spreads? There are several advantages to selling put credit spreads. I would have to say the number one advantage is that you are limiting your risk. The long put that you are buying serves as protection to the downside. The second biggest advantage is that you are using a limited amount of buying power. In other words, it doesn't require a lot of capital to sell put credit spreads. So beginners can sell put credit spreads in small accounts while they are still learning and new to option trading. Lastly, there is absolutely no risk to the upside, as you will see when we go through the upcoming example. We want the stock price to increase and go up, so we want to pick stocks that we are bullish on when we implement this strategy. What are the risks with selling put credit spreads? You definitely don't want to use all of your option buying power in your account and only sell put credit spreads. You can blow up your account. Since you are using leverage when trading options, you can still lose money. However, because options allow us to use leverage, we don't even need to do that. You only need to use a small portion, maybe 30, 40, 50% of your option trading investment dollars to complement and further grow your wealth. I recommend that you have a separate 401k, retirement, or savings account that you put the majority of your long-term investment into. We can then use the leverage in the smaller options trading account to both grow fast while also reducing risk at the same time. What types of stocks should we sell put credit spreads in? We want to sell put credit spreads in stocks where we are bullish and believe they will increase in price. We also want to sell put credit spreads in stocks with high IVR, which stands for implied volatility rating. This allows us to collect more option premium and go further away from the current stock price. In looking at the current one-year chart for Oracle, ticker symbol ORCL, we see that it has trended up, but just had a bit of a drop due to a slight revenue miss during their earnings report. So it's trading at $112 right now. We did our research and know that Oracle is a great company with solid fundamentals, including the income statement and balance sheets. It also has a pretty high IVR, implied volatility rating, at 18 for the current market that we are in. So this is a stock that is a good candidate to sell a put credit spread. How do you sell a short put credit spread? All right,
We're going to take a look at selling a put credit spread and break down the buying power, max loss, and profit that can occur depending upon the price movement of the stock. You can do this with any brokerage on any platform. We are going to use the Tastytrade platform. Tastytrade is one of the best brokerages for trading options. It's the one that I've used for many years, and they're the guys that developed TOS, the Thinkorswim platform, and sold it to TD Ameritrade, which is now Schwab, and the one they still use today. Tastytrade is even better. Right now you can get cash back when you open an account.
I'll put a link down below, and if you fund with at least $2,000, it really helps the channel out, and I really appreciate it. You need a couple $1,000s anyway to make a few different trades.
Here is an example of selling a put credit spread in Oracle, ticker ORCL. We punch in the ORCL in the upper left and make sure that we are on the trade page. This brings up the option chains. We will click on the October 20 chain to open it up, since it is 32 DTE, days to expiration, which is a good amount of time to still collect good premium. We click on the 112 strike bid and the 107 ask to sell a $5 wide put credit spread. The max profit is the $1.66 that we collect up front when we place the trade. One option contract controls 100 shares of stock, so it is $1.66 times 100 shares, or $166 that we receive the minute we hit send and place the trade. The max loss is the $5 width of the spread minus the $1.66 in premium collected, so it's $334. This trade has a 60% pop, which is probability of profit. The 166 that we are collecting is almost perfectly 1/3 the width of the strikes, which is what we want to shoot for. Now, if we switch to curve mode by clicking on curve on the trade tab, we can see the profit zone in green. The break even is calculated by subtracting the $1.66 collected from the 112 short put strike. So the break even is $110.34. We hit review and send and place the trade. If the stock price moves up as we want it to, then we can just close the trade at any time prior to expiration. Or we can wait until expiration and let the trade expire worthless, out of the money. This would allow us to keep all of the 166 as profit. All right, let's look at a few takeaways. Selling put credit spreads can be a great entry-level strategy for beginners, since they can be traded in small accounts using limited buying power. Max profit is the credit collected times 100 shares per contract. Max loss is the width of the spread minus the credit collected. Credit spreads should be sold in stocks with high IVR that you are bullish on. We can be assigned prior to expiration if the short put strike is in the money. So we need to be careful on that. And if that comes up, we can always roll out to the next month prior to expiration. To close a put spread, we can buy back the spread prior to the expiration date.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. There's also a link for coaching as well as an automatic options income course. Appreciate you watching. Please hit like and subscribe, share the video with a friend, and see you in the next one.